Hello, students. Welcome to the lecture on Chapter 4. In Chapter 4, we're primarily going to be talking about the income statement. Here's an example of an income statement for a typical manufacturing company. This is a pretty comprehensive, detailed income statement, but we'll be talking about this throughout this chapter. Okay, so for the first part of the income statement that we just saw, income from continuing operations section, and income from continuing operations are primarily revenues, so inflows of resources, and expenses, outflows of resources for the normal recurring type of operations for the company. So whatever they're in business to do, income from continuing operations measures the profitability of their normal recurring operations. So again, operating income includes revenues and expenses directly related to the main revenue generating activities of the company. In other words, what they're in business to do. Non-operating income are gains and losses and revenues and expenses related to things that are not part of their normal operations, but are one-shot deal type things, so peripheral or incidental activities, so things that aren't part of their normal operations. And we divide up the income statement into these two components to give us a better idea of how much money they're making from their normal operations, and then how much money they're making or losing from other non-related activities. Here is an example of a single-step income statement. In the single-step income statement, all the revenues and gains are lumped together, and all the expenses and losses are lumped together. And then you have an income before income taxes subtotal, and then we subtract income tax expense. We always show income tax expense separately, and then we finally get to net income. Notice that for the single step income statement, we don't try to divide up what we do into operating and non-operating income. All of the revenues are put in together. All of the expenses and losses, regardless of what they're for, are combined together. Okay, so there's no information about how much money they're making from their normal operations and then how much money they make from other non-related activities. So income statement, single step income statement is very simplified. The multiple step income statement, on the other hand, is more detailed. We start off with the gross profit section, and gross profit is sales revenue minus cost of goods sold. So gross profit is how much money did we make from purchasing inventory and then selling it. So gross profit is a pretty significant item, so because it tells us how much money we made from buying and then selling inventory. Operating expenses are next. Operating expenses are expenses of running the company. So these are selling expenses to sell the inventory, general administrative, sometimes called back office overhead expenses, and research and development expenses. So subtracting our operating expenses from our gross profit, we get operating income. So this is how much money we made from our normal day-to-day operations. Other income and expenses are gains and losses from things that are not part of our normal day-to-day operations. So for example, selling investments, if we made money or lost money from selling fixed assets. So things transactions that occur that are not part of normal day-to-day operations go into this non-operating items section. And just like the single step that we saw earlier, the income tax expense is shown separately to derive the net income. So this multiple step, it's the same information as in the single step income statement, just rearranged to provide more meaningful information. So it's categorized into various categories, like the gross profit area, operating, and then non-operating items are separated out. Multiple step income statements gives us more information about a company. This is a good time to kind of explain the difference between US GAAP and IFRS. IFRS, as you remember, stands for International Financial Reporting Standards. US GAAP, as you recall, are the rules that accountants follow in preparing financial statements. These rules apply only to United States, American companies, whereas International Financial Reporting Standards are followed by almost the entire rest of the world. So all the other countries of the world follow this International Financial Reporting Standard, whereas US GAAP is followed only in the US. Here's some different similarities and differences between GAAP and IFRS as related to the income statement. Some of the more significant differences. One is that the bottom line of the income statement in the US is called net income, whereas the terminology, and it's just a terminology difference, IFRS, the bottom line is called net profit or loss. Okay, so we don't use the word net profit in US GAAP, we call it net income, whereas internationally it's called profit. Extraordinary items are shown separately for US GAAP, whereas in IFRS, extraordinary items are not shown separately but are included as part of operating income. Okay, there's some smaller differences. Another difference is sometimes the titles are different. Under US GAAP, it's almost always called income statement, whereas in IFRS, that income statement is usually called statement of operations or statement of profit and loss. So again, the titles are different, even though they refer to the same thing. Okay, the concept of earnings quality. Earnings quality basically means is the earnings of a company permanent or is it a temporary earnings? The difference being a permanent earnings are recurring earnings. So this definition here of earnings quality refers to the predictability of future earnings. So earnings from your continuing day-to-day operations, those are considered to be permanent earnings. So that will usually follow from year to year. Whereas things like making a profit from selling off equipment, for example, that's not a recurring thing. That's just a one-time thing. So it's difficult to predict future earnings based on that item because it may or may not occur again in the future. Whereas earnings from day-to-day operations can be projected to the future. So it's always better to have earnings from your operating income, so from doing what you're in business to do on a day-to-day basis. Those earnings are better than earnings that are just a one-time kind of a thing. And that's what the term earnings quality refers to. Just concept things here, manipulating income, income smoothing. Basically, most companies, as is indicated here, prefer to have earnings that follow a smooth upward trend without a bunch of highs and lows and ups and downs. So companies sometimes manipulate their income by trying to shift income from one year to another, so that the income does have this nice smooth upward path. Wall Street investors prefer to see that kind of a earnings trend, smooth and upward. So it's a invitation for companies to try to manipulate income by forcing it to be their earnings to be smooth and an upward path rather than a lot of ups and downs. Okay, so that's again just terminology there. Let me skip over. Again, as I indicated earlier, earnings quality. Earnings that are generated from their normal day-to-day operations are better, are of higher quality earnings than losses and gains generated from one-shot deals like selling investments, as is indicated here. So selling investments, these non-operating income, can significantly inflate or deflate current earnings. So again, these are misleading because these are one-time things, gains and losses that occur. So it really is doesn't contribute to trying to predict future earnings growth and that type of thing. Yeah. Okay, there's two things in US GAAP that are reported separately of continuing operations, and we show those separately, each of these two things separately. One is discontinued operations. Discontinued operations are when a company eliminates or gets rid of a significant segment of their business. It could be a major product that they discontinue. It may be a segment of their business, a product line, for example. It may be a major geographic location that they discontinue. So if they get rid of a major segment or major portion of their business, that's considered to be a discontinued operation. And you have to show that separately. Because if you lose money, for example, from getting rid of a segment of your business, that's a one-time thing. You don't want to include that with your continuing operations and kind of dilute that figure. Yeah, because continuing operations are your day-to-day operations. That's what you're in business to do, quote unquote, your normal profits. You don't want to dilute that with losses from something unusual like a discontinued operation. So you show that separately. And I think we'll talk about another slide, but whenever we present discontinued operations or extraordinary items, we show those net of the tax effect. So if we have a loss, we offset that loss with tax benefits. So whenever we have a loss, we're going to get tax benefits from it. We'll learn that in a subsequent chapter in this course. Okay. But just be aware, if you have losses in these two items, you're going to have positive tax effects. So you show the net or the difference between the gross loss and the tax benefit. If these two items are gains, then you're going to have to pay extra tax on that. So subtract the tax effect from the two gains to get a net as well. So again, just be aware that these two items are shown as one line item. The total gain or loss on these two items and subtracting out the tax effect. So it's shown as a single line, shown net of tax. Okay, and again, discontinued operations, again, which are getting rid of a segment of your business. Extraordinary items. Extraordinary items are gains or losses, or losses that are both unusual in nature and infrequent in occurrence. Both of those criteria have to be met in order for something to be an extraordinary item. Has to be something that's really, really rare. Okay, don't worry so much about this. Okay, and again, we see discontinued operations. And again, discontinued operations, as is indicated here, is eliminating by selling off or just dumping a major segment of their business. So it could be a major line or product line, geographic area, okay, that type of thing. That's a discontinued operation. Excuse me. So there's two aspects of discontinued operation. One, when a company sells a segment of their business, they may have a gain or a loss upon selling that segment. A loss occurs when they sell the segment for less than the book value, the carrying value on the books. There's a gain if they sell the component for more than what it's on the books for. Okay? So at the time they get rid of this segment, there's going to be a gain or a loss from selling that segment. In addition to that, that segment has operated during the year from the beginning of the year until the day it was disposed of. So you have to report that income or that loss from operating that segment for the period of time during the year that it was in operation. Okay, so there's going to be a gain or a loss from just running that operation. That's this top portion here. Okay, so again, you have to report the gain or loss from operating that segment during the year, and you have to report the gain or loss from selling off that component or that segment. So those are the two, sorry, let me go back. Those are the two different components of discontinued operation. Those two things have to be combined in that line that we saw earlier, gain or loss from discontinued operations. So again, be aware that there are two different components or two different parts to discontinued operations. The normal day-to-day operations of that segment for the year, and then the gain or loss from selling that segment when it is sold. Okay, an extraordinary item, as I indicated earlier, it's again, material event or transaction, so that means it has to be of significant size, dollar-wise, and it has to be both unusual and infrequent. Both those criteria need to be met in order for something to be an extraordinary item. Yeah. If only one or the other is met, then it is not an extraordinary item and it is shown in the operating section of the income statement. Excuse me. So again, a difference between US GAAP and IFRS is under GAAP, US GAAP, We do report extraordinary items separately as a separate line item in the income statement. However, under IFRS, there is no such thing as extraordinary items. That gain or loss is included in operating activities. Okay, so as I indicated here, if it is one or the other, unusual or infrequent, but not both, then it goes into the continuing operations section and is not shown as an extraordinary item separately on the income statement. The chapter touches a little bit on accounting changes, and we will be talking about accounting changes in a subsequent chapter in Accounting 302 and Intermediate Accounting 2. So we won't really talk about that in detail here. Just be aware that there are three major types of changes. A change in accounting principle is when you change from one GAAP method to another GAAP method. An example of this is changing from FIFO inventory valuation to weighted average inventory valuation. That's a change in accounting principle. A change in accounting estimate is when you revise a previous estimate because of new information or new facts. As you recall, an estimate in accounting that we make is in the area of depreciation. We have to estimate the salvage value, and we have to estimate the useful life of the asset in computing depreciation. Those are both estimates because we don't know for sure what the salvage value is going to be or how long the asset's going to last. So we just have to make an estimate in the beginning. If later on we have to revise the estimate because we have some new information that causes us to change our mind about those estimates, then that's called a change in accounting estimate. A change in reporting entity is when the company itself is different because of some change, usually either adding or selling off a subsidiary or a major portion of their business. That's called a change in reporting entity. In another chapter, we will look at how we do the accounting for each one of these types of changes. But for now, just be aware of the definition of what these three different types of accounting changes are. Okay, here's some details on the change in accounting principle. Again, we'll talk more about this later, so don't worry about it now. So all these things are related to that. Correction of accounting errors. Again, we will talk about that in more detail later. If you find the error in the same year that it occurs, then all you have to do is fix it. So reverse out the original entry and then record the new entry. However, if you discover an error in a year after that you've already closed out, then you need to make a prior period adjustment. In other words, you have to go back and fix the beginning retained earnings, and you have to correct the prior year's financial statements. But again, we'll go over that in more detail when we go through the subsequent chapter on accounting changes. Okay, the concept of earnings per share. Okay, earnings per share is a widely used ratio. You have to express earnings per share in the income statement. It's usually shown at the very bottom of most income statements. And basically, the earnings per share is, the basic earnings per share is your net income minus your preferred dividends. Preferred dividends are dividends paid to preferred shareholders. And earnings per share, we are computing for common shares. So we have to take out these preferred dividends that go to preferred shareholders. So you take the net income less preferred dividends, you divide by the weighted average number of common shares outstanding. So if the number of shares of common stock does not change through the year, then the denominator is simply the number of shares that were outstanding for the whole year. On the other hand, if we did change the number of shares outstanding by issuing more shares of common stock or by buying back shares of common stock, then we have to do a weighting of the shares. And no, I guess not. We'll go over this in homework as far as what happens, how to compute the weighted average number of shares of common stock if it changes during the year. This concept of diluted earnings per share that have the option of being converted to common stock by the holder of those investments or those bonds. So the bondholder, for example, has a right to change their bond into common stock if they want. Diluted earnings per share basically changes the number of common shares outstanding and adds to that the potential number of common stock if all of the people who have the option of changing their securities into common stock, if all of them decided to do that, then the total potential number of shares of that type of convertible, they're called, instruments, is then added to the actual number of common shares that are outstanding. So it's the total number of common shares outstanding plus the potential conversion of all of the other instruments into common shares. That's called diluted earnings per share, and we'll go over that in more detail later. Okay, so earnings per share, you have to disclose that, and you have to show earnings per share information separately for your income or loss from continuing operations. And if you have discontinued operations or extraordinary items, we show the earnings per share for each of those separately as well. And then we have an earnings per share for your net income or loss. If you don't have either one of these two items, discontinued operations or extraordinary items, then all you have is one line for earnings per share for net incomes. So you don't need these categories here. And again, these are shown, earnings per share data is shown at the bottom of the income statement in most cases. Sometimes, though, it's shown as a separate statement, but again, more often included at the bottom of an income statement. The concept of comprehensive income, there are certain items that are not included in the income statement as gains or losses, but then are shown separately, and these are the items that are included in this other comprehensive income category. So there's certain, and then again, these are pretty narrow. I mean, they don't occur very often. So things like, and the most common one of these is probably changes in the market value of certain investments. Okay, in the income statement, we normally do not adjust certain investments to market values. Okay, so we show those types of changes in market values in this category called other comprehensive income. Another fairly common OCI, other comprehensive income, is gains or losses from foreign currency exchanges. Okay, and again, Um, this is going to be discussed in advanced accounting, which is a master's level course here at Chaminade. Okay, but just be aware other comprehensive income are things that are not included in the normal income statement. And here's an example of how it's shown. Net income, and then you add these 4 specialized other comprehensive income items. Okay, so there's a post-retirement benefit plans, this gains or losses on market value of investments. Again, we'll look at all of these items in a subsequent chapter, okay, or in a subsequent course actually, but just be aware that there are these 4 items that are called other comprehensive income that are added or subtracted from net income to get this called comprehensive income. This is either shown at the bottom of the income statement, or sometimes there's a separate statement about comprehensive income in the set of financial statements. So you don't have to know these for right now, the details of these. Just be aware that there are these different adjusting items, I guess, called other comprehensive income. So here's some differences between GAAP and IFRS. They're essentially, it's the same between the two, except for IFRS has a 5th item, which is changes in the value of property, plant, and equipment and intangible assets that the US GAAP doesn't have. Let's see. Don't worry about that. Okay, statement of cash flows. Statement of cash flows is a required financial statement, and it provides information about where cash came from and where cash went to. There's 3 different sections of the statement of cash flows. Operating activities section. Operating activities are what the business is in business to do. So what is their normal day-to-day operations? So selling to customers. Interest and dividends are also included in operating activities. So inflows are money coming in. Outflows are money going out for normal day-to-day things like buying inventory, paying salaries and wages, and other operating expenses. And again, interest is included in this section as well as income taxes. So think of operating activities as inflows and outflows for their normal operating activities, what their day-to-day operations. We're going to get into this in more detail in, again, a subsequent chapter on statement of cash flows. But just be aware for now, there are 2 different methods for reporting the operating activities, direct and indirect methods. We'll get into the details of that in a subsequent chapter. Okay, so let's skip all of this for now. Okay, another section of the statement of cash flows is called investing activities. These are cash coming in, cash going out for transactions related to long-term assets. Okay, so like property, plant, and equipment, for example, in long-term investments and long-term receivables. Okay, so again, inflows and outflows. So investing activities are related to cash coming in or cash going out for transactions related to long-term assets. Financing activities is the 3rd section of our statement of cash flows. And these involve transactions related to long-term liabilities and stockholders' equity transactions. So if there's any cash involved in those kind of transactions, those are called financing activities, and they're shown in that section of the statement of cash flows. So here you can see the three sections: operating activities, investing activities, and financing activities. And again, we'll get into the details of statement of cash flows in a subsequent chapter. And so don't worry about this for now. Okay. The only difference between GAAP and IFRS with respect to statement of cash flows is where dividends and interest are located. So for GAAP, dividends received, interest received, interest paid is all in the operating activities. Dividends paid are in financing activities. In IFRS, however, dividends received and interest received are in investing activities. Dividends paid, interest paid are financing activities, and none of those go into operating activities. Okay, so slight difference here between GAAP and IFRS with respect to statement of cash flows. Okay, just touching upon this project that the FASB, Financial Accounting Standards Board, who basically come up with US GAAP, and the IASB, International Accounting Standards Board, who develop IFRS. Those two bodies are working together to try to come up with some kind of common standard that everyone in the world can follow. But that's been going on for many years now, that project to try to come up with a common set of standards. And who knows when that's going to be finalized, if it ever will be. They are still negotiating things together. And again, we don't know when that's going to happen. So don't worry about that. Okay, that's the end of chapter 4. So until next time, aloha.